1031 exchange versus cash out refi. Today I'm going to show you how to figure out which one is best for you, and be sure to stick around until the end where I'll answer the most frequently asked questions regarding these strategies. I'm Tyler Cobble, and welcome back to my channel where each week we're sharing commercial real estate investing strategies, leasing and management tips, market updates, and so much more. If you're anything like me, you're constantly evaluating your real estate portfolio to determine if your equity is being utilized to its best potential. And that means exploring all options to see if you might be able to pull out that equity and place it somewhere else so that you can get a better return. There are really only two ways that you can realize this equity in any of your investments. Either you sell the property or you perform a cash out refinance. But which one is better for you? Selling your property and performing a 1031 exchange, or refinancing the project and pulling all of your cash out? Well, first, what is a 1031 exchange? In short, the 1031 like-kind exchange is derived from the Internal Revenue Service's 1031 tax code, which allows any property held for business or investment purposes to be sold and the proceeds exchanged into another property without having to pay capital gains taxes. That is to say, this code allows you to retain all of the profits when you sell a property and then reinvest them into a property of equal or greater value, as long as you locate and purchase the property within a certain time frame. If you want to take a deeper dive into 1031 exchanges, check out this video here. Now, what is a cash out refinance? Well, a cash out refi is similar to a traditional refi whereby you place new debt on the property and pay off your old loan. However, if you've created enough equity in the property through value add or have held it long enough to build up your equity position, you can actually take on a larger loan so long as the debt service coverage ratio doesn't dip below 1.2 or so, meaning you will actually take out more cash from the new loan than you originally put into the property. Pretty neat, right? This cash that you pull out from the property is considered a loan, so it's completely tax-free, and you're welcome to spend it on anything you want. And hopefully that's more real estate investments. So which is better, the 1031 exchange or a cash out refi? Well, just like everything in commercial real estate, it depends. Before you can really determine which path is best for you, you should ask yourself the following questions. What are the pros and cons of each option? Well, with a 1031 exchange, you get a large chunk of cash and can immediately move that into a larger property, which is certainly a pro. However, you no longer own the original asset, which can be seen by some as a con. And if you don't properly execute the 1031 exchange, you could end up liable for capital gains taxes from the sale. Now, in a cash out refi, you will be taking out capital tax-free since it's actually a loan, which is always nice, but you will be likely increasing your monthly debt service and therefore decreasing your cash flow, which could be seen as a con. There are also fees that a lender will charge you when going through a refinance, but you do get to keep that property in your portfolio. Next, you should ask yourself, what are your long-term goals for this building and this location? If you're only looking for the next strong investment opportunity that gives you decent cash flow and appreciation, then you're likely going to take the 1031 exchange route since you will have more capital to buy a larger project elsewhere. However, if this property is in your neighborhood and you'd like to hold it for a long time because of that, you're likely going to refinance the site so that you can continue to cash flow and hold on to it. Your long-term goals will certainly play a factor into your decision. Then you should ask, what was your original intent with the property? If your strategy was to fix a building up and flip it for a quick profit, you likely won't qualify for a 1031 exchange, which would obviously eliminate that opportunity altogether. If that's the case, you're likely utilizing the BRRRR strategy, check out this video here, and will want to refinance the property as soon as possible to pull out that equity you've created. Your original intent for the site only really matters for the 1031 since there are more steps to properly qualifying for a like-kind exchange. However, you could actually use a more advanced strategy and do both a 1031 exchange and cash out refi. The beauty of both of these strategies is that they allow you to snowball your wealth so long as you keep the capital you pull out of the project in play. Let's say you purchase an office building, fix it up, and stabilize it with new tenants. You've created quite a bit of equity in that property and now you want to pull that out. You could execute a cash out refi, buy a shopping center, and after you've held that shopping center for a while, you could sell it and 1031 exchange the proceeds into a third property. On the flip side, if you wanted to sell that office building, you would be able to 1031 exchange those proceeds into the shopping center and immediately refinance after closing to pull out some of that trapped equity. Of course, none of these strategies are quite that simple, so I highly recommend that you consult your broker, attorney, and CPA when considering any big financial moves. Now, which one do I prefer? I actually like to utilize the cash out refi strategy over 1031 exchanges. Now, that's because my investing strategy is a bit unique compared to most investors. I prefer to invest as much as I can within a 15-minute radius of my office, which is largely East Nashville and Madison. I also own a commercial real estate brokerage and commercial property management company that run my projects, so it helps when we have a concentration of properties in a manageable territory. So I'm more of a buy and hold kind of guy, but there's certainly a season for each strategy, and I've definitely sold assets to perform a 1031 exchange under the right circumstances. Now for the frequently asked questions. How soon can you refinance a 1031 exchange property? As soon as you want. You are permitted by the IRS code to refi the property as soon as you close on it. Keep in mind though that you either need to close on the new site in cash or negotiate with your lender to avoid a prepayment penalty so that you don't lose any money by refinancing the debt. How much can you cash out on a refi? The amount that you pull out on a project will largely depend on how much equity you've built up in the property and the current monthly cash flows. Most lenders won't exceed around 80% loan to value and prefer to see at least a 1.2 times debt service coverage ratio to ensure that they don't have too much risk in your asset. Other than that, it's not uncommon to be able to pull out up to 2 times your original investment or even more. It completely depends on how much value you've created. Can you do a cash out refi, then 1031 exchange that property? No, you cannot. Be very careful here because the IRS may flag this transaction and you would lose any benefits from doing a 1031 exchange. They interpret a cash out refi near the sale of a property as the seller realizing that profit ahead of time. So I highly recommend having those conversations with your CPA before you do anything. All right, now that you know the differences between a 1031 exchange and a cash out refi, check out this video here on how to do a 1031 exchange, where I walk you through the steps of properly executing a like-kind exchange and everything else you need to know during the process. I'll see you there.